Hey guys, so many of you would have come across the term mortgage, especially in regards to taking out a property or buying a property. You could have heard your family or your friends saying you're going to go out and get a mortgage. Now, we're going to have a basic look at what mortgages are in the UK. So, we're going to do a quick series on mortgages in the UK edition. The first thing to know is the mortgages are just a different type of loan, and it's usually securitized based off a property. So a property is attached as a security in exchange for the loan, and the intent of taking out a mortgage is always to buy or purchase a property. So it's just a loan that's taken out on the security of a property in order to buy the property. Now, many people take out a mortgage from sort of various reasons. Some of them prefer to buy some residential property so they can sort of stay in their own house rather than sort of renting out a house. Some people go out and get holiday homes, uh, and then you get the third kind of investor who is more interested in making it as a source of income, and they would use the mortgage to buy a property that they can buy to let. Again, different reasons, but all of that sort of boils down to the fact that you're taking out a mortgage to buy a property. Now, if you go to a bank in order to take out a mortgage, they usually run a quick assessment by you, and that assessment uh, kind of looks at three things in particular. So the first thing that the bank tries to assess is your income, uh, and or specifically the security of your job profile. So they kind of need to know what kind of salary you're drawing and how secure your employment is. And obviously, the higher the income and the more secure a job is, the higher the chance that you could get a mortgage, or the higher the chance you can get a higher mortgage, so to speak. So, income and security of employment. The second thing that the bank really assesses for is your current or your existing outgoings. Now, this could be a bunch of things, such as your utility bill or your household expenses if you've got kids, the school fees, and generally they just want to see what your current expenses are. Obviously, banks are interested in knowing if you can actually pay back on the mortgage without default. So they need to assess your income, which is the first portion, which is the kind of money you're drawing in, and second is to see how much money you sort of leak out in expenses. So this could be utility bills, your fees, and just general day-to-day household expenses. Now, the third thing that they look for is quite important. It's called a LTV ratio, or specifically a loan to value ratio. So LTV ratio. LTV stands for loan to value, and this is quite simply looking at the size of the loan in relation to the value of property that you're going to buy and your income, right? So the loan to value ratio, or the loans to earning ratio, is just to see the property you're going to buy, and they're going to sort of compare it with the size of your income, your salary, and